I would say it wasn't only that travel rule adoption was in its nascent days, but I would also say the requirements were in the nascent days. And so this has radically shifted, where today we have, I think, the most recent stat from the FATF earlier this month in July 2024 is that 65 countries have already passed legislation that includes travel rule. And then there's another 15 or so who are in the process.
Hello, and welcome to Public Key. This is your host, Ian Andrews. 2 years ago, the CEO of Nota Bene, Pelle Brandegard, joined the podcast to talk about his company and this new regulation called the travel rule. At the time, most crypto businesses were just trying to figure out how to meet their regulatory obligations. Today, we're getting an update on the company and the status of travel rule implementation internationally. I'm joined by Pelle's co-founder, who is also Nota Bene's chief operating officer, Alice Knauffel. Alice shares her origins working in the decentralized identity space and how she leveraged those concepts when venturing into the intricacies of travel rule compliance and the evolving regulatory landscape. Alice and I talk about the challenges in creating solutions for seamless cross-border transactions, while highlighting how regulatory clarity, like the European Union's MiCA, is poised to revolutionize institutional trust and compliance in the crypto world. The conversation also focuses on self-hosted wallets and counterparty risk assessments in the crypto space, while offering insights into how the interoperability challenges for the travel rule solutions can be solved. After the episode, if you want to go deeper into the subject matter, head down to the show notes, where we have provided links to Nota Bene's 2024 State of Crypto Travel Rule Compliance Report, and some additional blogs that help virtual asset service providers ensure they're complying with transactions with self-hosted wallets. Now let's get into the episode. Excited for my guest today, Alice Knauffel, who's COO at Nota Bene. It's exciting to have you here and get an update 2 years in the making. How are things going?
Yeah, thanks so much, Ian, for having me join here. Things are going really well. Excited to be here and chat about, I guess, all the things we've missed talking about in the past 2 years.
It's going to be fun. Let's start with a little of your background, Alice. So I noticed you're a Y Combinator graduate. You started your career in consulting. It seems like you've been in digital assets for a long time. Take us through, what drew you into the world of digital assets, blockchain, and cryptocurrency?
Yeah, good question. Yeah, earlier in my career, I was in consulting, and around that time decided to take a bit of a break, go back to school, and did, an MBA, like many people did. Combined it with a policy degree, and at the time I was looking at very much what are some of the fundamental changes that we will be seeing from a technology perspective over the next 10, 15 years. And I was very interested in that kind of connection between how we're evolving as a world from a technology perspective and how does that kind of interact with policy, both at a local level and a global level. And during that time, it was around 2015 or so, 2016, there was obviously a lot of great things happening from a fintech perspective, whether these were the payment processing and point of sale solutions, the kind of different trading platforms coming out, etc. And while a lot of it was very exciting, I was fundamentally interested in how can we basically help with a lot of the key infrastructure that will enable even greater access to financial services globally. And hence entered kind of the rabbit hole of, blockchain, crypto, and decentralized identity around that time. Went and kind of talked to a lot of people to see what was going on in this space. And I definitely saw the promise for infrastructure which can enable infrastructure such as identity at the core, which can enable greater kind of access to different services, including financial access and so forth. So anyway, long story short, at the time, decided to look at different digital identity and more specifically decentralized identity teams around the space. And that's where I met the teams at Consensus, and Uport more specifically. I was a product team at Consensus and ended up joining the space around 2017.
Yeah, tell me about what Uport was doing. Decentralized identity seems to have a bit of a resurgence or a hot streak at the moment, right? I mean, a lot of people are trying to figure out what the folks at WorldCoin are doing, as an example.
Yes.
But, Circle's got a project in the area. There's quite a few smaller startups that are focused on this. It feels like you were way ahead of the curve, maybe back in 2016, 2017. What was Uport's take on the space?
Yeah, it's interesting because today I see there has been almost like in many ways, many steps forward, but also it still feels like we're going around in circles in that space. Ultimately, the problems that we're trying to solve are really big and will have such a big impact. And these problems have only exacerbated since. And so that's why you continue to see resurgence. However, it's just really hard to solve identity problems with an identity solution because fundamentally it's linked to every single use case. And so since 2016, we've seen a lot of teams working on everything from trying to solve identity problems for healthcare or for things like WorldCoin or for driver licenses and so forth. But ultimately, it's a bit of a hard chicken and egg problem. But I could just talk very briefly. At the time, we were building some core infrastructure to really help solve one of the problems that we identified within the blockchain space, which is by design, ledgers are public and they should not have identifying information there. However, for most transactions, you should be able to identify your counterparty and you should be able to, as needed, depending on the use case, be able to link real-world identities of people and businesses to their blockchain addresses. And so that in and of itself as a problem still exists today. There are different ways of tackling this. And every day I hear different companies in the space across different parts of the space trying to tackle it. We were building fundamental kind of, I would say, like infrastructure for that, initially within the Ethereum ecosystem and then more broadly. And some of that infrastructure that we built is today part of the World Wide Web standards and forms, I would say, almost like the basics of what everyone else is working on today. It's great to see that. And I'm very bullish in the long term, but nonetheless, I still think it's going to take time.
Yeah, can I be maybe a little bit controversial on this topic? At the core of it, it seems like any sort of identification system relies on a level of trust. And decentralization, I think, has been made synonymous in this industry with like absence of trust, or at least we don't need to have trust in order for the system to function. And to me, those seem in collision in some way. Like the easiest way to build a digital identity system is to have a trusted real world identity provider who like validates and credentials you, and then you get that credential in digital form and you can use it with applications. Like it's basically what we do with digital certificates for websites today, and like kind of how VeriSign works as an example. That's not perfect, but it's a system that seems like plausible we could deploy at scale and copy and improve on. And this idea of trustless identity like is a big head scratcher to me, because I don't know how we get this original validation without some proof. Am I totally missing like the obvious capability here?
Yes, it's a good question. I wouldn't say that you're missing it. I would say it's a very valid point. Yeah. But what I would say is, as an industry, we've actually thrown around the word decentralized and trustless and made basically, how shall I say it? But essentially, we've done all of us a disservice here. Because at the core, the way decentralized identity systems work, maybe I should use a different word, which is self-sovereign identity. But essentially, what we're doing here is, and part of what we had built back then, but also, I must say, Nota Bene's infrastructure is also built on decentralized identity infrastructure. What this means is, in that world, there are credential issuers who basically would issue a verifiable credential, which is essentially just a digitally signed proof, and then would hand it over to you as an individual or institution, but you have that record that it has been similar to kind of like the VeriSign kind of example that you gave, where you would essentially have that signed proof. Let's say that you own a specific bank account, or that you are a Coinbase account holder, or maybe that you have, I don't know, certain types of medical data and so forth, and then you can be able to share it with a third party. But in essence, the data that you have here, now if let's say a medical provider shared it with you and you're taking it to another medical provider, they know to trust it because it's been digitally signed by the first medical provider. And so it is, I would say, kind of like similar to what you said, but done in a more self-sovereign fashion. But it's not about trustless, because it is all about creating trust within the specific use case. I'll give another example. Basically, I can use decentralized identity kind of mechanisms to issue a credential that I like ice cream. That's cool. Everyone likes ice cream. However, now if I have another credential that says I'm a Coinbase account holder, and maybe let's say there is some sort of a DeFi platform which only allows KYC'd individuals to interact with it, then I can take that credential and prove that I can work on it. And so it's really just about, I would say, kind of the system on the back end. And it's not about being trustless. It kind of depends on the use case itself.
So it's not about being trustless. It does sound, though, like there needs to be a reliance on a central verifier or credential issuing authority in that example you just gave, if I'm following it correctly.
Exactly. And rather than have these potentially having the issuing authorities manage all that data and create a centralized honeypot. The idea here is then that they can provide that back to the individual or the entity, and then you can take it elsewhere. And so in thinking back to the example of, let's say, a medical provider, you go to one doctor, they issue you a certain amount of kind of data, and then you want to go to another hospital system, and you're able to take that with you.
Fascinating. So now, after doing that at Uport for a while, that was a nice tangent divergence there into a topic I'm fascinated with. You decided to start Nota Bene. Tell me about what led you to wanting to work on this problem.
It's actually really related. And if we go back even to that question that you asked me around trustless systems, fundamentally, and here kind of thinking back to the crypto space, public ledgers by design don't have identifying information about the counterparties of a transaction. And that makes sense because this is how we can preserve the privacy of the interacting parties. However, for many use cases, you need to be able to identify the counterparty. There needs to be a mechanism by which the two parties of a transaction are able to identify, verify each other, and then be able to trust that they're sending funds to the right counterparty. And so stemming from that and from our work, Decentralized Identity, we knew that this is something which has to be built for the space. There needs to be a way in which the counterparties of a transaction are able to identify each other securely in a privacy-preserving way, if they want to do that, to be able to allow those transactions to happen. And so from our perspective, we knew that this has to happen at some point, and it has to happen for proliferation of use cases, everything from e-commerce, cross-border payments, and then the FATF, or the Financial Action Task Force, around that same time that we were already kind of thinking about this, came out with their virtual asset guidelines for the space. And as part of that, they made the requirement of travel rule a necessary thing for the industry. And so what exactly is travel rule? And before I jump into that, I would say from our perspective, we saw basically when the Financial Action Task Force came out, I think it was mid-2019, late 2019, came up with a regulatory framework for the crypto industry. We thought that was a really good endorsement from the regulators, that essentially they're coming in to provide that regulatory clarity to allow companies in this space to be able to start transacting compliantly with one another, get regulated, get the licenses that they need, and be able to interact with the broader financial ecosystem. And so from our perspective, then around that time really sounds like a great moment for the space, because this will unlock a lot of new companies, it will allow a lot of growth, but at the same time there are specific rules to how they need to interact with each other. And one of those rules was the travel rule. And so we saw in that a parallel to some of the work that we had done earlier. And the requirement in and of itself is that financial institutions and crypto asset service providers need to perform risk assessment of the counterpart of a transaction prior or with the transaction settlement. And so this specifically means that for every transaction that's going from one institution to another, the institution will have to identify and verify who the counterparty is of the transaction. And as part of that, also be able to communicate with the counterpart institution, if that exists, unless it's a transaction to a self-hosted wallet. And what does this mean kind of like more specifically? Let's say if I would like to send you right now a crypto transaction, my institution, the exchange I'm working with, will need to, first of all, identify who you are. They're going to perform, basically based on their own risk-based approach, specific checks to ensure that you're not a high-risk individual. They're going to check whether your account is at another centralized institution. If it's not, there's potentially some requirements depending kind of on the jurisdiction. But if your account is at a centralized institution, then the requirement is also that they collaborate and communicate with each other to ensure that neither you nor I are high-risk individuals. And you may ask, what is the point of all this? Well, clearly here the point is to identify any suspicious activity. They want to make sure that you're not potentially sanctioned individual, a high-risk individual. They also want to make sure that the institution that you have your funds at is a trustworthy institution. So again, this is taking almost the opposite of trustless, right?
Well, I was going to say, it's interesting to think about where you started, which was wanting to facilitate counterparty trust in the transaction so that you and I could know that we're sending to the right people, which at its most basic level in crypto is kind of that terrifying moment where you put in an address and you're going to send off some digital assets and you hope there wasn't a misfire on a copy paste operation and your assets are gone forever, or you sent to the wrong address somehow and your assets have been burned. That seems like something that everyone in the industry would use. The second case where the solution evolved to seems much more like a back office process that large financial institutions have to by regulation are sort of being pushed to embrace. Any thoughts on that reflection?
It's an excellent reflection. And it's crazy because I would say that from an institutional perspective, that second part, it is true. It is part of the back office checks that they have to perform to ensure that they're in compliance with the regulatory requirements. But it is also fundamentally, as they're performing this is the first time where they are able to identify and verify counterparties in a deterministic fashion. This is the first time where they are able to, because of that communication that they do with their counterpart institution, is actually determine that X amount of transactions are going to these jurisdictions or to these exchanges or to these on-ramps, off-ramps. And it kind of goes hand in hand. And it is kind of interesting because I would say we've kind of gone from us seeing where this could end up in a few years, because it's all around transaction authorization. But there was the regulatory requirement of travel rule, and that's what we're helping companies with. But we already see a lot of our customers come to us for the transaction authorization piece. It's the same data, it's the same flows. But ultimately, are you doing this just as a compliance function, which is a very important piece for companies? But with that, you're also starting to understand and get that data around who your counterparties are, the types of transactions you're doing. And then this also becomes part of that enablement of those use cases. Now, it is still a bit of a tricky kind of thing, but ultimately you are right in your reflection. It's kind of like the two sides of the same, I'm not sure what the expression is, but two sides of the same coin.
2 years ago when we had your co-founder Pele on the podcast, the capability was still, I would say, in the nascent early stages. Most organizations in the crypto industry were still trying to figure out, like, what do we actually need to do with the travel rule? Catch us up on the last 2 years. I know that a number of jurisdictions have put into effect the requirement that transactions abide by the regulation. What else is going on in the industry over the intervening time since we last covered this topic?
Like in all things in crypto, the last 2.5 years have definitely evolved quite dramatically and look very different.
Understatement of the year, Alice.
Exactly. But where shall I start? I would say the first thing to look at is the evolution of the adoption of the travel rule over the last 2 years. Looks very similar to the uptake of licensing and registration regimes globally, because ultimately it's tied to that. And so I would say 2 years ago, crypto companies generally operated in a largely unlicensed, unregulated world, with the exception of a few jurisdictions. Their transactions were also largely non-compliant. And that's basically because the rules were at an early stage where the regulators were still trying to understand exactly how they should introduce those requirements and what they should look like. The technology was evolving quickly, and they had to really determine what this exactly should look like and how it should apply in different scenarios and so forth. And so I would say it wasn't only that travel rule adoption was in its nascent days, but I would also say the requirements were in the nascent days. And so this has radically shifted, where today we have, I think, the most recent stat from the FATF earlier this month in July 2024 is that 65 countries have already passed legislation that includes travel rule. And then there's another 15 or so who are in the process. So from a regulatory standpoint, the FATF has been pushing globally all regulators over the last 2 years to push that forward. And I would say this is, dramatically larger today than it was a year ago and so forth. And again, this is, very similar to the amount of jurisdictions who have put licensing regimes for crypto. So with that regulatory clarity, this is kind of shifting fast. The latest two jurisdictions are Seychelles and New Zealand, who are in the process of instituting the travel rule. But what we saw over the last year were some key jurisdictions such as the UK, the UAE, Hong Kong. And now we're at a place where with the EU's MiCA and TFR, which is their version of the travel rule coming into effect later this year, we're nearing that point where there's a global regulatory tipping point. And we look at this from the perspective of like, where are we today and where will we be in a year to 2 years time? Because fundamentally, we talked about institutions having to collaborate to perform the travel rule. So it takes two to tango in this case. And one of the key things that we had probably, and when Pele was also here on the podcast 2 years ago, is it takes two to tango, but it probably in most cases felt like there was one dancer and the other one was absent. Yeah. And that's because of an issue that regulators call the sunrise challenge, where jurisdictions roll out the rules on different dates. Companies get licensed not all on the same day. And so ultimately it's really hard for institutions to have performed the travel rule properly 2 years ago. And so where we are today, when I talk about a global tipping point, is that we're reaching the place where most companies do expect to be able to send a travel message to their counterparties and receive a travel message from their counterparties. And so I think in the next 6 months, we're seeing with the EU rules a very kind of rapid adoption, and not just within the EU, but globally. Most larger crypto companies, whether in the US or APAC, are getting EU licenses or are also getting ready, if they were not fully compliant before or complying before, to also comply, because the rules in the EU require that your counterparties comply, and if they don't, you can report them to the regulator. And so we believe that this is kind of that moment where things will look radically different in 3 months, in 6 months, in 12 months, but also where we are today in terms of volumes and activation is very different from where we were last year. I'll give a couple of examples. We see today more than our customers, and this is just looking at our customer base, but we see transactions going from over 30 jurisdictions originating, going to over 85. And I would say in terms of volumes transacted through Nota Bene, we've 100x volumes today versus where we were in January of last year. And this just talks to like that rapid growth over the last year to year and a half from an industry perspective. But we expect this to be literally still kind of that early days of where we're going to end up over the next 18 months.
I'm curious the impact of that. So the growth in volume is fantastic, 100x and more than almost tripling the number of jurisdictions who are participating. What does that mean practically? Is it users are getting tricked into sending funds less than they were in the past, like less exposure to scams? Are VASPs detecting more money laundering and kind of like stopping funds in transit? Have you been able to pull any of those results out through your analysis?
Yeah, great questions. So we have a policy engine for our customers whereby they basically institute their own kind of compliance processes to be able to identify high-risk activity and prevent those transactions from happening. And what we have seen is close to $1 billion in prevented volumes to date.
Wow.
And we don't know what are the specific reasons, but we expect a lot of it is probably due to either identifying high-risk counterparties, whether this is specific blockchain addresses or whether this is based on like named sanctions. It's also potentially going to whether it's high-risk or non-compliant counterpart institutions or jurisdictions and so forth. And I still think this is the early days because in most cases, companies are still trying to figure out what does this exactly look like? What does it mean? And that's why I think the next 2 years will be interesting, because that's where companies will finally have access to the data on their end around who their counterparties are and be able to make smart decisions on whether they should interact with them. It'll also enable them to expand access to potentially counterparties where previously they didn't have the mechanism to be able to assess whether they're high risk or not, or whether they can be trusted or not. And so I think that we see this as, we're equipping companies with tools to be able to get smarter in real time to allow more transactions to more counterparties.
Can I just pull on that thread a little bit? So ultimately the goal is allow more transactions through because you'll have more confidence, where in the past you just didn't know. And is that actually true though? My sense in the crypto industry is the attitude was, if I don't know for certain that it's bad, I'm not getting in the middle of it. Like I'm not going to stop anything and I'm going to seek as little knowledge as possible. Like maybe that's a little too cynical way to represent the industry, but I would say that was kind of the historical behavior that I observed when I first got into the space 3.5 years ago.
Yes, I would say that there's probably a couple of different camps. Definitely, I would say 3.5 years ago, that was probably the case for the majority of companies in the space. But I would also say that they didn't have tools to do any better.
Okay.
And the requirement was not there as well. But in essence, for many companies since who have started operating in the space, whether these are new companies who are crypto native or whether these are fintechs or banks who are starting to transact with crypto, essentially they come in, especially the ones right now who are going through all the licensing requirements, they're starting in with very much kind of that, who are the counterparties I can trust? And how to even perform diligence on them. Shall I onboard more than 2, 3, 5, maybe 10 counterparties? Because how do I assess who, besides a couple of companies where I have a lot of information about them, how do I assess it, that they are low risk and that they will pass my risk department's kind of assessment and so forth? And so we are working right now with a couple of our TradFi customers on helping them expand who they can transact with, because of now that they have the tools to perform that diligence on their counterparties. and have been able to show that those counterparties are travel compliant and perform kind of like the right checks when transacting with them in a compliant way.
That's good to hear that attitudes are shifting in that way. And I'm curious also, my understanding of your solution is that there's a data exchange that happens between the two participants in a transaction that's sort of sent out of band. So if I'm sending you some funds from my exchange account to your exchange account, I request that withdrawal or that transaction be initiated, and then out of band via Nota Bene, the exchange will pass my details and confirm your details, the destination information. So that basically exchanges roughly simultaneous to the transaction. Am I missing that you all are now providing some measure of risk on those counterparties? Like, are you saying to the initiating VASP, hey, I know Ian wants to send Alice some money, but Alice is doing business at a very shady exchange, and you probably should not allow Ian to send this money. Is that a capability that you're offering, or is that information supplied through other partners or third-party means? Like, how do you get to that assessment?
Good question. Essentially, this maybe goes back to, we talked roughly around the travel requirements and then transaction authorization. What we do at Nota Bene is we help companies perform in real time those counterparty risk checks, both on the end counterparty and on the counterpart institution, and then decide whether the transaction should go through. And part of that is also the out-of-band communication and message layer. However, think about the requirement, it's about identifying and verifying the counterparty, performing those risk checks, performing VASP due diligence, and communicating that message. One part of it as well is if the transaction is not going to a counterpart institution, is owned by the end user using a self-hosted wallet, the requirements are still there without the messaging part, meaning that the onus is on the originating institution, in this case, to perform those checks of the counterpart. And so what we help companies with is with performing all those checks. And as part of this, the data that they have at hand includes some third-party data. It also includes the data that they're gathering at the point of transaction around the counterpart. And it also includes data which the counterpart institution can share with them. So we do allow for VASP due diligence within the product. And so each VASP creates a profile, and then there is some third-party data, there's some self-reported data, but ultimately they can also build trust through their transactions with the counterparties.
I see. So it's not Nota Bene providing risk assessment of any particular entity. It's just the tools to facilitate the process of data collection. And I guess I'm curious, like in the moment of transaction, in my example where I'm like, hey, send Alice some money, are your customers frequently interceding in that withdrawal request moment and saying, oh, no, Alice's wallet is hosted by an institution that we don't want to do business with? Or is it more of a broad process where they kind of periodically evaluate all counterparties and like, you know what, this exchange that we seem to have a lot of customers sending funds to, they're not sanctioned, but they are some indication of illicit activity happening broadly, and we want to stop users sending funds there. So we're just going to block any transaction requests that terminates at that provider.
Yeah, it's actually both.
Okay.
And so in essence, it is correct. We don't perform any kind of risk assessment ourselves, but what we do is provide the tools for our customers to do that. And it makes sense. I would say the regulatory obligation is on them to perform those assessments, but also no two institutions are similar. Each one is going to approach this in a separate way. And maybe this also goes back to some of our earlier conversations here around what does trust mean, and empowering institutions to be able to perform those, to basically come up with their own risk-based approach and based on their own risk appetite, decide who they want to transact with, what rules they want to have in place. And it could be that for different products, they may have different appetites. It could be as well because of different rules and requirements in every jurisdiction, they may apply different things. And so we leave it to the VASP themselves. And often what we do see is the teams would upfront put together a robust kind of process in place where they may say we're not comfortable with transacting with these jurisdictions, and we're only comfortable allowing these types of transactions with these types of institutions. However, it's also a very fast-moving space, as I'm sure you're aware, and we often see that companies' regulatory status may change as many companies are waiting for their licenses. Or in some cases, some companies may lose their trusted status. And while it makes sense to kind of do that more kind of robust upfront and then put that into our policy and rules engine, and we see companies do that, and then periodically they also go back and review, especially once they have their data probably on a quarterly basis or half-annual basis, biannual, to be able to see like what are some of the misses that we've had and what are some of the edge cases, and then go back and re-review those. But ultimately at the point of transaction too, we do see there it's probably less on a VASP to VASP part, but it's probably more around the end user is where most transactions which get rejected would happen, where there could be some missing information, beneficiary names may not match, and so forth.
It's back to our question of decentralized identity. And can I withdraw my funds out to a self-hosted unknown wallet, or do I need to actually verify that the wallet's somehow in my control? And I've seen all sorts of proposals bouncing around about technical means by which I could validate I have control of the wallet, like a signed message that I could demonstrate to sort of ensure that the withdrawal is satisfied. But I'm not aware that anyone's actually implemented anything like that. So it seems to all be living in the technology specification land, not actually in practice.
Well, it's funny that you say this. We have actually provided proof of ownership for self-hosted wallets for the last 2 years. And we've only recently expanded the types of wallets that we support, and we'll continue to do that. And ultimately,
tell me more about this. I've totally missed this capability. So how does it work? Like if we wanted to implement it for a customer today, like where do you start?
So today we support basically ERC20 type wallets, as well as hardware wallet.
So it works with my MetaMask or my Trezor.
Yes.
Or my,
Yes, exactly. Yep. Ledger wallets, etc. And we're in the process of adding more methodologies right now. And I would say there's a couple of drivers for us right now to expand this. And the main one is that the EU travel requirements will require when customers withdraw funds or receive funds from a self-hosted wallet, that they do prove ownership of that wallet if the funds are above 1,000 euros. And so that is a regulatory requirement. And it's important that we do solve it as an industry, because otherwise it puts transactions with self-hosted wallets at risk. I think the specific requirement is that VASPs will have to implement a risk-based approach to this. So in addition to identifying the owner of a self-hosted wallet, they will have to verify it for above that threshold using only one method. Originally, it was 2 methods, and then we basically pushed back as Nota Bene and as an industry, and we're able to get it to 1 method. But in this case, it's also up to the VASP after that, whether they want to request potentially additional information or conduct enhanced ongoing monitoring and so forth. In practice, we're going to see how that exactly looks like, but I can tell you that this is not a new requirement in some places like Singapore and a few other jurisdictions where it's been there for at least a year or more. And many of our customers do use that functionality already. It's not exhaustive yet, just because there's a lot of different types of self-hosted wallets. And there's a bunch of different methodologies that can be used. You're right in saying that some things stay in the technical specification land, but others are just really suboptimal.
Yeah, my impression was that to meet this requirement, most people were just going with some sort of self-attestation. I basically sign a form saying, yes, I own the wallet. And so it's legalistic, maybe enforceable. I'm not a lawyer, so I won't comment on that. But it's not technical in terms of demonstrating actual possession of the private key. And so I think a lot of crypto people were taking that as an affront, because it was like, no, it's so cryptographically provable that you actually do control that wallet. Why aren't we using a technical solution to this problem versus requiring documentation and this sort of theater of signing a legal agreement?
Yes.
So I've got a MetaMask wallet, and what happens next? How do I use your solution? Am I paying Nota Bene money? Do I have to have my exchange support your product and then they give me some sort of tool? Like what happens next?
Yeah, it's actually a very neat solution. Our customers usually integrate into their front end a UI element. It kind of looks like a Stripe checkout pop-up. So essentially at the point of transaction, when you're putting in a wallet address, we will perform the checks on whether this is an address which the VASP has already identified before and worked with, or whether it's part of our network and so forth. If it is a new address, at that point in that pop-up, we will ask the end user to identify whether they're sending that address to another institution or to a self-hosted wallet. And think of this as when you're doing a wire transfer where you're going to have to then provide some information to identify the counterpart of the transaction, such as providing an IBAN number, account number, and so forth. And so at that point, basically, if you say it's going to an institution, then we would initiate a travel transaction with that institution and check that they indeed own that wallet address before performing the travel and sharing any PII with them. But if it is a self-hosted wallet, and in this case, for example, a MetaMask, what would happen is it's a 2-second flow. As an end user, you would receive a little pop-up through your MetaMask where then you would sign with a cryptographic signature. from a UI perspective, it literally is just one button. But at that point, basically there would be a cryptographic signature stored with the exchange that at this particular point in time, you as their customer signed that you own that wallet.
Very cool.
And then this happens in real time at the point of transaction. And then it's up to the institution or VASP, in this case, whether they want to have this be a reusable thing or whether you have to do that at every withdrawal to a self-hosted wallet.
That's fantastic. And you've got customers who are live running this today?
Yes. And some have probably been using it for over 2 years.
That's exciting. I think I would be remiss to let you go without asking this question. I recently had a group of our customers together, and I think one of the biggest challenges they identified with Travel Rule was the fact that there's not one provider and one standard. As fantastic as you all are, there are competitors out there. And so it becomes not only this challenge of getting multiple businesses and jurisdictions all around the world to collaborate, but then also a data interoperability problem with kind of competing system architectures. What's your thinking on this? Because I heard a bunch of frustration from our customers who were like, there's got to be a solution here. We either need consolidation in the industry or we need some sort of like meta layer across all this stuff. Like, how does this eventually play out? Because it seems like it might be the biggest point of friction, particularly as the regulations come into effect where this has to get very real in the near future.
It's a great question, Ian, and I would say it's not only a frustration from the industry and your customers, but I would also say from the regulator's perspective and from ours as well. And in many cases, I would say, we talk a lot in the industry about interoperability across different messaging layers, but you hit the nail on the head when you said that ultimately that creates a system architecture problem, because while it sounds ideal, in practice, it's a large waste of energy. Because you have different messaging protocols, they have different flows, they've evolved in different ways. And so that makes it really hard. Another part of it also is many of the different protocols have low usage. So we'd be wasting a lot of energy creating gateways from one to the other. And I do think as an industry, we've already wasted time doing that. And we could have spent that time really helping kind of the industry move along on some more critical questions, such as having fantastic technical solutions to self-hosted wallet transactions, for example. And so from our perspective, we have been pushing a lot on the industry front, but also in speaking with the regulators that instead of focusing on interoperability between protocols, is let's focus on VASP to VASP reachability. We need to make sure that we don't create isolated islands. And we need to make sure that there aren't unfair advantages or disadvantages created due to competitive purposes, where there could be an isolated island that basically allows or does not allow certain exchanges in. So I think as an industry, it would be great if we could, instead of wasting energy on creating interoperability between different messaging protocols, just take a step back and choose one that makes sense and create really a global network in terms of reachability, because ultimately we all benefit from all institutions being able to have access to transact with each other. And then going back to some of our earlier points here, it's up to the institution itself and their own compliance processes, whether they want to trust another institution and whether they want to allow another transactions with another institution. And that goes back to equipping them with the tools to make those decisions, and for it to happen on an institution-to-institution basis rather than at a network basis. And I don't think that we're alone in thinking this. I would imagine most of us across the industry feel this. I hear it from our customers every day. But ultimately, I would say this is kind of the method to go forward. Now, from our perspective, we'll continue to rally the industry around this. And we do think that we're reaching that tipping point where everyone's afraid of having isolated islands or networks. And it makes sense for us all to work together on bridging that gap. The other part as well is, we're taking a bit of a novel approach as Nota Bene by thinking about what are the networks where crypto transactions are already occurring. And so these happen in, networks like think about custody providers or MPC wallet providers. And so what we're thinking from our side as well is, why don't we make it easy to bring a layer of compliance to the networks where crypto transactions are already occurring? So for instance, think about Fireblocks. They're both a partner of Nota Bene as well as a partner of Chainalysis. And clearly they have a very large network of companies who transact with one another. It makes sense for them to be able to enable, because given that compliance layer has to happen right before the transaction settles, that we can just meet them where they're at. And so for this, we just launched recently, I think it was last month, a solution called Safe Transact for Networks, And we're seeing already a lot of interest on that front from some really big players. We'll be hopefully announcing them shortly. But with that, it's all about how do we think about where companies are already transacting today and just making sure to break barriers and not create more walls and more islands in the space.
That's fantastic, because I think the usability in the crypto ecosystem is already challenged. So creating islands of walls around them and we're unable to send transactions through does not do anyone anything beneficial. I want to close the podcast and give you the opportunity. Looking forward, what are you excited about? What should we expect from the company? And what have you got your eyes on across the industry over the next 12 or 18 months that we should be watching for?
I'm excited for a couple of things. The first one is I'm really excited with MiCA coming in by the end of the year that we are providing regulatory clarity when it comes to stablecoins, as well as the regulatory clarity that a lot of financial institutions need to start launching crypto products, whether this is within the stablecoin realm, whether this is within tokenization. But we see this through a lot of our pipeline and new customers. And I'm really excited about how quickly we're moving alongside that. And putting this hand in hand with as well the travel rule and the trust element, where what we are bringing in here is, and tying it back to the earlier in the podcast when I shared around transaction authorization, we believe that for many of the institutions coming in new into the space, that added layer of trust is really going to help them launch some of the use cases that we've been talking about here for years. So everything from the remittance corridor use cases to cross-border payments more broadly. And I'm seeing this kind of rapidly evolve almost, I think, in every kind of strategic conversation I've been part of in the last 3 months. And from Nota Bene's perspective, we'll continue to build the tools that will equip those institutions with being able to perform due diligence quickly in real time, be able to instill trust internally in which are the right counterparties they should transact with, and also be able to measure success daily. And so with that, I think it's going to be kind of hand in hand as we see kind of the industry evolving over the next 18 months.
Really exciting. I'm looking forward to it. Alice, this was a fantastic conversation. Thanks so much for joining us on Public Key.
Thanks, Ian.
Hey there. Thanks for listening to another episode. If you enjoyed what you heard today, do me a favor. Open up your podcast app, rate the show, give us a review, tell us what you liked. Even better, you can share the podcast with your friends. And of course, make sure you subscribe so you don't miss the next episode. In this episode, we covered quite a bit of the European Union's MiCA regulation and their version of the travel rule, and Chainalysis just released a 3-part blog on MiCA and the remaining challenges it has, especially for stablecoin regimes. Part 1 of the blog provides on-chain insights on stablecoins and the different types of stablecoin regimes. Part 2 focuses on stablecoin usage in the European Union, jammed with charts on daily usage and other metrics. Part 3 highlights the remaining challenges, including how MiCA will practically be implemented and the future of stablecoin regulation. We also discuss how Chainalysis is supporting crypto asset service providers and stablecoin issuers with these new requirements and how they can gain a competitive edge with our market intelligence reports. Find all 3 parts of the blog and a ton of graphs and charts by going to the link in the show notes below.